Have you ever wondered why price skips over your perfectly marked fair value gaps or order blocks, leaving your pending orders unfilled? What if I told you there's a way to fix that? Today we're discussing order flow, a crucial concept that many traders overlook in their plans. By mastering this concept, you'll be able to predict upcoming price movements more accurately and finally understand why your trades don't always go as planned. Most importantly, in the final part of this video, I'll reveal an exclusive trading plan to help you capitalize on order flow like never before. Welcome back, traders. So, let's get started. One of the most common questions traders ask is, why does the price sometimes move in the predicted direction, but fail to tap into key zones like order blocks or fair value gaps? Especially when the price action creates a perfect trading setup based on their strategy. Everything seems fine, but then the price moves away before reaching their identified order block or fair value gap, leaving their pending orders unfilled and missing a great trading opportunity. This is where understanding order flow becomes crucial. Many traders overlook this concept in their trading models, but mastering it is essential for more accurate market structure mapping and analysis. So, what is the core mindset behind order flow? At its core, order flow highlights areas on the chart where the highest volume is traded before a drastic upward or downward move. These areas are where smart money either hides their positions or initiates the remaining portion of their positions. When the price returns to these zones, it often reacts and reverses in the opposite direction. By analyzing order flow, traders can better predict market direction and identify key supply and demand levels. Think of order flow as the bigger picture and order blocks as smaller, specific zones within it. Order blocks are decisional areas formed before institutional orders are executed, and they tend to command high respect from price action. Similarly, areas defined by order flow also carry a high probability of influencing price movements. Keep in mind that the market does not always tap into or mitigate order blocks or fair value gaps before reversing and continuing in its dominant direction. Price may reverse even before reaching these areas, primarily due to the presence of order flow. In such cases, waiting for the price to hit those extreme zones might waste time and energy, as the price may not return to those areas anytime soon. By focusing only on these extreme zones within the order flow, you might miss other trading opportunities. Now let's look at how we can identify order flows in the market. Technically, order flow refers to areas on the chart where buying or selling pressure builds up before an expansion or a break of structure. There are two types of order flow. Bearish order flow forms during a bearish market profile, and bullish order flow forms during an upward market profile. From the candlestick perspective, bearish order flow refers to the last bullish or buying candles formed just before a sharp and sudden downside move. This area typically includes at least two consecutive buying candles to be considered a valid bearish order flow. Bullish order flow is the opposite. It refers to the last bearish or selling candles formed before a strong upward move. Learning and applying the concept of order flow provides valuable insight into market structure and significantly enhances your trading skills. Additionally, order flow can be used to develop various trading strategies since these areas are recognized as zones where smart money is most likely to enter the market. Now, let's take a closer look at order flow in more detail. Let's imagine we have a bearish market profile as shown. The price formed a swing low, then retraced back up to clear the liquidity above this structure. Suddenly, the price experienced a sharp downward move, breaking the previous swing low to the downside. The zone containing the last buying candles before this sharp drop is known as the order flow zone. It represents the final buying momentum that occurred just before the price broke lower. Within this order flow zone, we can also identify an order block, which is associated with the break of structure. If you look closely, you'll notice that an order block is essentially a more refined version of the order flow zone. Traders often wonder why the market didn't respect an order block, even when it was perfectly in line with their trading plan. The main reason price doesn't always mitigate order blocks is order flow. Order blocks are often located at the extreme end of an order flow zone, which means price can reverse direction before ever reaching the order block. It's essential to understand that order blocks are just one element of order flow, and should not be the sole basis for trading decisions. Let's break this down further. In the following, the price retraced back to the inducement zone and showed a tiny pullback before suddenly pushing upwards, hitting the stop loss of traders who entered the market by selling at the inducement zone. After taking the liquidity, the price continued its upward movement until it reached the order flow zone. At this point, price reversed to the downside and continued its primary bearish trend. Once again, we can identify an order flow zone here. This particular zone represents the last moment of buying pressure before the price drops and creates a break of structure. At the extreme end of the order flow zone, we have an order block. So, this scenario highlights the fact that price tends to respect the order flow zone more than order blocks. It's important to note that we use order blocks to optimize our trading strategies by identifying an optimized zone of order flows to set up our entry point, and also